Hello and welcome. So, without sounding morbid, and in the words of Benjamin Franklin, in this world nothing can be certain except death and taxes. And in this video, we shall discuss the latter in the context of shares and ETFs for your EasyEquities account. Let's get started. I just would like to add in a quick disclaimer that this video is only addressing the tax matters on your local South African shares. So, you have purchased shares using your EasyEquities account, and it is now time for you to sell your shares. Now, you know as well as me that we have to pay tax on any income earned as we are socially responsible corporate citizens. That being said, how can we calculate the amount of tax that we have to pay? I'm going to briefly go over the theory and then take you through some easy examples in order to solidify your understanding. Just before we get started, I want you to understand the following things. There are two types of taxes when we talk about shares. When it comes to shares, you will always pay one, normal tax when you sell your shares. Then two, you will also pay dividends tax while you hold your shares. Please note, you only pay dividends tax when and if a company pays you a dividend. So, normal tax is paid when we sell our shares, and dividends tax is paid when we receive a dividend payment from a company whose shares we hold. Let's start with normal tax. So, what happens when we sell our shares? Okay, so when we sell our shares, we need to determine whether the proceeds, so the money we are getting from the sale of those shares, are either revenue or capital in nature. Now, these may sound like weird terms, but we'll get there. This is important because depending on whether the shares are revenue or capital in nature, this will affect the tax treatment and the amount of tax you pay. So this is a very important distinguishment. Revenue gains are taxed at a higher rate than capital gains. And you as a buyer and seller of shares have to prove to SARS that the shares are capital in nature. Otherwise, they will just be deemed to be revenue in nature and you will be taxed at the higher rate. For someone who doesn't have a legal or accounting background, bear with me. So, revenue in nature is where the shares are held as trading stock and are ones that you bought for the main purpose of reselling at a profit. Any gain or loss you make on disposal of a share that is held as trading stock will be of a revenue nature. So, realistically, what does this mean? If you are aiming to sell shares which you have bought in the past purely with the intention of making a quick profit, then SARS will classify the sale of those shares as revenue in nature. Revenue gains are subject to income tax at your marginal tax rate, we'll get there in the example later, which may vary between 18%, but effectively 0% if your tax rebates are taken into account, and 40%, depending on the level of your taxable income. So between 18 to 40%, that is the amount of tax you would pay on the profit. On the other hand, we have shares which are of a capital nature. Now, capital nature is not defined in the South African Tax Act, and we would have to refer to case law and many factors in order to determine if the shares are capital in nature. As this video is meant to keep things simple and as brief as possible, there is a simple and easy rule which automatically deems shares to be capital in nature in the Tax Act, and this is Section 9 Cap C. Now, Section 9 Cap C stipulates that shares are capital in nature when they have been held for 3 or more years before disposal of these shares. Now, there are other factors which can deem shares to be capital in nature, and they don't have to be held for 3 years. However, these factors are not set in stone and are dependent on the surrounding circumstances. These are beyond the ambit of this video. To keep things simple, hold your shares for a minimum period of 3 years, sell them, and they will be deemed to be capital in nature and taxed as such. For individuals, capital gains are taxed as follows. First, take the profit, so the difference between what you bought and sold the items for, and apply the annual 40,000 Rand exclusion to this amount. i.e. you will reduce the capital gain by 40,000 Rand. Then take this figure and multiply it by the CGT inclusion rates, which for individuals is 40%. Then you include this amount in your taxable income, which then gets multiplied by your tax rate depending on your tax bracket. So theory out the way, let's do some examples to bring some clarity. Okay, so in order to go ahead and calculate the tax that we would have to pay from the sale of our shares, we need to first have a rough idea of just the basic tax which we would pay on something like our salary. So bear with me, just want to give you guys a rough example for how do we calculate the tax we would pay on something like our salary, and then we will get to the shares. So this example applies to the tax year 1 March 2020 to 28th of February 2021. Every single tax year for individuals starts on 1 March and ends on the 28th of February the following year. And seeing that we are in 2021, this is the most accurate time period, most relevant time period for everyone watching this video. So let's go ahead and do a rough example. So you are 25 years old and we are assuming the following. You are earning a salary of 300,000 Rand, and that is over the period 1 March 2020 to the 28th of February 2021. Okay, so basic example, how is this taxed? Well, that salary, that 300,000 Rand, would be considered gross income. Okay, gross income, it is a defined tax term. Without giving you all the jargon, this is something that would land up being taxed. It's an income, it's an inflow, and we would have to pay tax on this. So assuming this is the only form of income you get, this amount of 300,000 Rand would then be classified as something called taxable income. Now, taxable income is what you need to calculate in order to go ahead and determine the amount of tax that you are going to have to pay SARS. So when you have this figure for taxable income of 300,000 Rand, we are going to use this to determine how much money we will pay SARS in the form of normal tax. In order to do this, we need something called the SARS tax tables. Now, if you look here on the right, this is the SARS tax tables. And if you look here in the left column, say the taxable income. So we need to go ahead and calculate our taxable income, and then we can go ahead and calculate the tax payable. So if you look here, the column on the left, there are a bunch of ranges. We quite simply need to find the range within which our taxable income falls. So our taxable income is 300,000 Rand. Within which range does 300,000 Rand fall? I think you guys can all agree with me it falls within the second range, which is 205,000 Rand all the way up to 321,000 Rand. So once we've identified the range, we then just look to the right. The amount of tax we would have to pay would be 37,062 Rand plus 26% of the taxable income above 205,900 Rand. So the taxable income above 205,900 Rand, how would we calculate that? We're just going to take the 300,000 Rand minus 205,900. That gives me the taxable income above 205,900 Rand. So if you look here in Excel, I went ahead and essentially just put that formula in here, and it calculated this figure of 61,528 Rand. Now, quite simply, there's one more step we need to do, and that is account for the primary rebate. This rebate is essentially a reduction in the tax we have to pay SARS. It's something that every individual is granted, and just need to note that it is dependent on your age. So if we look here, we are assuming we are 25 years old. In order to calculate this primary rebate, we need to use the primary rebates table. If you look here for the 2021 tax year, which once again is from the 1st of March 2020 to the 28th of February 2021, for someone who is less than 65 years of age, they will be granted 14,958 Rand. If you're 65 years or older, you get 8,199 Rand, and if you're 75 years and older, you get 2,736 Rand. Please note that this is an additional rebate. So for someone who's 65 years and older, they'll get the 14,958 as well as the 8,199. And someone who's 75 years and older will get all 3 of these rebates. So just something for you guys to keep in mind. So once you've gone ahead and done that, we're going to take the amount you got from the SARS tax tables less the primary rebate, and what do we get? We get the normal tax payable, 46,570 Rand. Please remember this number because it will be relevant when we look at the next example. Okay, so we're going to use the exact same figures, but let's now throw a share sale into the mix. So if we look here, exact same stuff, we're 25 years old. Let's assume we earn a salary of 300,000 Rand over the period 1 March 2020 to 28th of February 2021. And let's also assume during that exact same time period that we purchased 10 shares of company Y, which were trading at 2 Rand. And within 6 months of the year, we go ahead and we sell those shares. And the price that we sell them at is 12 Rand per share. So, very similar to the initial example. Of course, we're going to once again include the 300,000 Rand salary. Now, as we went through previously, before I jumped into this Excel, you guys will remember that we need to determine if shares are revenue and capital in nature. Now, I think everyone can see that based on the facts and circumstances of the sale, this would appear to SARS as a quick fix profit-making scheme. We bought the shares, 6 months go by, we sell them, we're not there to hold dividends, we're not there to get any type of capital appreciation. This is clearly a revenue in nature circumstance and event. So we have to include this in our gross income. Okay? How do I get this figure of 100,000 Rand? We take the 10,000 shares we bought, multiply it by the price at which we sold them, minus the price at which we initially bought them. So it's essentially just the profit we made on the sales, and add these two figures together, the salary as well as the profit on the sale, and we get our taxable income of 400,000 Rand. Now, the rest of this is essentially exactly the same as the previous example. We're going to use our taxable income of 400,000 Rand in order to find within which range we sit in the SARS tax tables. So if we come over here to the SARS tax tables, we don't fall within the first range, we don't fall within the second range, but we can all agree that we fall within the third range. So the range that stipulates 321,000 Rand all the way up to 445,000 Rand. So using this range, we will then go ahead to the right here. We see that we would owe SARS 67,144 Rand plus 31% of the taxable income above 321,600 Rand. So once again, I've included the calculation here so you guys can see how it's calculated. And just remember the last step, go ahead and account for the primary rebate. Once we've done that, we can see here that the normal tax payable is 76,490 Rand. This is the amount of tax we would pay to SARS. Now, how can we specifically calculate the amount that's purely due to the shares? Well, quite simple. We're going to take the normal tax payable that we calculated in the first example I went through with you, which was 46,570, and then we're just going to go ahead and use this figure, subtract it from 76,490, which is the normal tax payable after we've accounted for the sale of our shares, so the profit on the sale, and you go ahead, subtract these two figures from each other, and we get a figure of 29,920 Rand. So purely due to the sale of the shares, we are going to have to pay an additional 29,920 Rand. Now, I want to stipulate with you that, or just share with you rather, that the amount of tax you pay obviously varies. It varies depending on your taxable income, because your taxable income will determine the amount of tax you pay, right? Because it falls within which range you sit, it determines within which range you sit, and that consequently determines how much tax you pay SARS. But this is just an example, just so you guys can see, roughly speaking, in this case, if you landed up selling those shares and you made 100,000 Rand profit, you will have to pay roughly 30,000 Rand from that 100,000 Rand profit to SARS. So let's now move on to a sale of a share that is capital in nature, because you guys understand from the theory, capital nature is taxed at a lower rate. So I'm sure this would be of interest to you. So, exact same examples. You're 25 years old, earning a salary of 300,000 Rand. You once again purchased 10,000 shares that are trading at 2 Rand. And the key here is that 4 years go by and the share price is now sitting at 12 Rand. And let's just assume that we're looking once again at the period 1 March 2020 to 28th of Feb 2021. Let's assume that you sell these shares during that period. So, yeah. Okay. So, similar but not so similar. What do we do that is similar? First thing is gross income. Once again, guys, your salary, it doesn't change. Your salary, put it into your tax calculation. It is gross income, 300,000 Rand. Now, we have something called a capital gain inclusion. So remember what I said in the theory. If we hold shares for 3 years or more, it will automatically be classified as capital in nature. This is a strict law, section 9 cap C. Now, how do we calculate this capital gain inclusion of 24,000 Rand? Because you'll remember from the previous example that we had a figure of 100,000 Rand, which was the profit on the sale. So where am I getting this 24,000 Rand from? I want you to come over here to the right. If you look here, we'll see the very familiar 100,000 Rand, which is the exact same 10,000 shares multiplied by the price we paid at the beginning minus the price we paid at the end. Then from that, we will go ahead and subtract the exclusion, the 40,000 Rand capital gains exclusion, and that gives us our net capital gain of 60,000 Rand. Now, for individuals, you then have to take your net capital gain of 60,000 Rand and multiply it by the capital gain inclusion rate of 40%. That gives us 24,000. So you guys can see it's a few more extra steps, but essentially that's how we go ahead and calculate our capital gain inclusion. And the rest of this example is pretty much the same as what you used to. You take the capital gain inclusion, add that to your gross income, essentially, and all of that falls under your taxable income. So you'll then take your salary of 300,000 plus the capital gain inclusion of 24,000. That gives us a taxable income of 324,000 Rand. And you'll go ahead and follow the exact same steps, use the taxable income, determine which range you fall within, use that range in order to calculate the tax payable, subtract your primary rebates, and there you have your normal tax payable of 52,930 Rand. So, where the shares are capital in nature, then, how much extra tax are we paying on the gain we made of 100,000 Rand? Well, we're going to take the normal tax payable. Remember, this is the normal tax we calculated at the very first example. Subtract that from the normal tax payable we just calculated. And what do we get? We get 6,360 Rand. So on the profit we made of 100,000 Rand, we will only be paying 6,360 Rand in the form of tax to SARS. So, big overview. Let's just take a step back. What is the difference in tax between revenue and capital nature, assuming the circumstances of the scenario? We can see here that the tax we pay to SARS, if the shares were revenue nature, is roughly 30,000 Rand, and if the shares are capital nature, it is roughly 6,000 Rand. So that results in quite a large difference. So what about dividends? You know those payments you receive from the company for holding those shares. How is that calculated? Well, quite simply, when you receive a local dividend, the company paying you the dividend will withhold 20% of the dividend amount as withholding tax, and the other 80% you will receive. That is quite simply it. So you yourself do not have to pay any tax to SARS. This is because the company is doing this on your behalf by only paying you 80% of the dividend. So quite simply, the 80% portion of the dividend you receive is yours, and you don't need to pay any additional tax on that. I hope you all enjoy this video, and I will see you in the next one.